Leverage doesn't multiply profits, it multiplies risk. So what ratio do you actually need? Here's the answer.
Leverage is a ratio. That's it. It tells you how much position size your broker will let you control for every dollar of margin you post. At 30 to 1, the cap in Europe, the UK, and Australia, $1,000 of your money controls $30,000 of currency. At 500 to 1 offshore, that same $1,000 controls 500,000. Same deposit, wildly different exposure. And here's where almost every beginner gets it wrong. They look at 500 to 1 and think it means 5 times the profit. It does not. Your profit per pip is determined by lot size, not by the leverage ratio on the account summary. A $10 pip on Euro USD is a $10 pip at 30 to 1, at 100 to 1, at 500 to 1. Leverage doesn't multiply gains. It multiplies what you're allowed to put at risk. That distinction is the whole video, so let's pull it apart. Forex positions are sized in lots. A standard lot is 100,000 units of the base currency. A mini lot is 10,000. A micro lot is 1,000. If you want to trade one standard lot of Euro USD, $100,000 of notional exposure, you either post the full 100,000, which is 1 to 1, no leverage at all, or you post a fraction. At 30 to 1, you post about 3,300. At 50 to 1, US retail on majors, 2,000. At 500 to 1, 200. The exposure is identical. The cash sitting in your account is the only thing that changes. So if the profit potential is the same in every row, what does the extra leverage actually buy you? Capital efficiency, nothing more. You open the same trade with less of your own money locked up as margin. The problem is what beginners do with that freed up cash. They open bigger. Here's the failure mode. A trader on a $1,000 account at 500 to 1 realizes they can afford 3 full lots of margin, so they open 3 lots. Now a normal 50 pip pullback, the kind Euro USD does before breakfast, is a $1,500 loss on a $1,000 account. They are not blown up by the leverage ratio. They are blown up by using the leverage as permission to oversize. The ratio is the rope, the position size is the noose. That's the misconception out the way. The mechanism most people miss sits one level deeper in how margin call actually triggers. Every broker sets a margin level, equity divided by used margin times 100, below which your trades start getting force closed. In Europe and the UK, ESMA mandates closeout at 50%. In the US, the NFA wants 100%. Offshore, some brokers let you ride down to 20%. A few let you ride to 10%. And that sounds like a feature. More room before liquidation, right? It's the opposite of a feature. Lower closeout thresholds keep losing trades alive longer. They turn what should have been a manageable stop out into a full account wipe. Now here's the math that should change how you read leverage forever. At 30 to 1, Euro USD has to move 1.67% against you to have your margin cushion. At 500 to 1, it has to move 1/10 of 1%. 1/10. That's a normal minute of price action on a quiet day. That is the entire reason ESMA capped retail leverage at 30 to 1 in 2018. Not because regulators hate traders, but because that single number is the highest impact lever on the retail loss rate. Lower the ratio, lower the blow-up frequency. The data was unambiguous. Which brings us to the global picture, because the cap your broker offers depends entirely on which entity you sign up under. UK, FCA, 30 to 1 on majors. EU, under ESMA, 30 to 1. Australia, ASIC, 30 to 1 since 2021. The United States goes a little higher, 50 to 1 on majors, 20 to 1 on minors. Canada, around 45. Singapore, 20. Japan, 25. Then offshore, Seychelles, St. Vincent, Vanuatu, 200, 500, sometimes 1,000. Same broker brand, different legal entity, completely different rulebook. There is a backdoor. Under MiFID II in Europe, you can apply for professional client status. That unlocks up to 500 to 1 at some brokers. The bar is real. A portfolio of 500,000 euros plus, at least 10 trades per quarter, documented financial services experience. And the moment you classify as professional, you lose negative balance protection, and you lose investor compensation coverage. The leverage goes up, the safety net comes out. Now the question every beginner actually wants answered. What leverage should you use? Here's how prop firm risk managers think about it. Never risk more than 1% of account equity on any single trade. Position size is determined by your stop distance, not by your leverage ratio. The leverage you choose should be just high enough to not constrain your position sizing, and no higher. Run the numbers. A $5,000 account trading 20 pip stops on majors, 10 to 1 is more than enough. You are never using 30. You are absolutely never using 500. The extra leverage is an empty promise. The marginal utility is zero. The marginal risk of overtrading is very, very real, which is why the well-regulated names, Pepperstone, IC Markets, Oanda, AvaTrade, offer 30 to 1 on their European entities and don't put it in the hero banner. They lead with platform quality, execution speed, and regulation, not the ratio. Which brings us to the brokers that do lead with leverage. Exness, up to 1 to unlimited on certain accounts under their Seychelles entity. FBS, 3,000 to 1. HFM, 1,000 to 1. These numbers are engineered to do one job: convert a beginner who thinks leverage equals profit. And if you're a European or UK retail trader, that offshore entity is not even genuinely available to you. The broker cannot legally onboard you under it. Any broker that bends that rule, your money has no FSCS or ICF protection if things go wrong. None. So the verdict: leverage is a tool, not a product. You can run a profitable book at 2 to 1 for decades. You can blow up a $10,000 account at 30 to 1 in a weekend. The variable that matters is position size and stop discipline, not the ratio on the account summary. Remember that 0.1% figure from earlier? The move that halves your cushion at 500 to 1? That is exactly why up to 1,000 to 1 in a broker's hero banner is not a feature. It's a flag. The brokers whose entire conversion pitch is the leverage number are the brokers you do not want your money with. Pick the broker that earns your account on execution, regulation, and platform. The ratio will take care of itself.
Leverage doesn't multiply profit, it multiplies risk. Check the description for the complete breakdown.